Hi everybody, this is Andy Bojarski. I'm the broker owner of Bojarski Realty and also of Montage Mortgage. And I'm going to talk to you about this great property that we have on Hydrangea Street in Murrieta. And so many people are renting and they're paying $2,000 to $3,000 a month in some cases. Rents have gone up tremendously. And we're going to show you in this video how you can own this home with so little money out of pocket that you literally can buy it with just a few $1,000s, and you're going to see that your monthly payments on this house are going to be extremely comparable to what you're paying in rent. So the purpose of all of this is to explain to you in this video how you can get into this house with minimal money out of your pocket and have payments that are similar to your rent, which you're currently paying for. So let's take a look to see how this can happen. Here's the financial summary for this house and how we're going to break this down. So you can buy this home for $399,000. This is the list price. This is what the seller is requesting or asking for when they sell it. So you can buy it for this amount of money, and your total monthly housing payments on this house, which is principal, interest, taxes, insurance, and also private mortgage insurance. You need private and mortgage insurance for this house, and we'll go over that. That's about $2,682. You're probably paying between $2,000, maybe $2,500, $2,600 in rent already. So maybe for a few hundred more dollars, you could be owning this house. We're going to show you how to get there. And your total out-of-pocket to buy this house is just under $4,500, $4,420. And this can be a gift from a family member. So you can literally buy this house with nothing out of your pocket. And again, this video will show you how to do that. So again, stop renting, start owning, stop allowing the landlord to dictate to you how you're going to live. The rent might go up. Maybe they're going to give you a notice, then your family has to move again. It's very stressful, frustrating. You can be the owner, and there's tremendous tax benefits. The interest that you pay on this loan, you can deduct off your Schedule A, and you can get tax benefits to help you. So there's tremendous advantages of being a homeowner, and we'll go over all that. And you can move into this house in 45 days. So, within a month or two, a little bit over a month, you could be a homeowner. So again, this video will discuss on how to do this, and hopefully I got you a little excited. And so just watch a little bit more and see if this is something that makes sense for you. So understanding CalHFA, this will be your loan program. So the financing for this home will be a CalHFA loan. Now what is CalHFA? CalHFA stands for the California Housing Finance Authority. It does not loan money to consumers. CalHFA works through approved private lenders, which I'm a part of, to qualify and make all mortgage loans. CalHFA actually buys these loans that meet their guidelines, and they provide special financing and down payment assistance to first-time home buyers, and we'll get into that. And they've been around since 1975. And it's a state program, so it's not like it's somebody that it hasn't been around. It is through the state. All other programs are at no cost to the taxpayers, so it doesn't cost myself money to have this program running. And all loans must comply with state and federal and CalHFA guidelines, which we'll go over in this video. So next slide. How will the loan structure be set up for you to purchase this home? The sales price, let's assume, will be $399,000, which is the price that the seller is looking for. You'll have a first loan for $387,030. That's 90% LTV. And what LTV stands for, it means loan to value. So if you take this first loan amount and you divide by 399, it'll equal 0.97 on your calculator. That's 97%, and that's just the way that CalHFA structures their loans. So you'll have two loans to buy this house. You'll have a first loan for $387, and then you'll have a second loan that you'll have to pay as well for $13,965. Now notice, this is more than 3%, because 97 and 3 would equal 100% of this. It's actually a little bit more. So CalHFA overfunds by 0.5%, and that 0.5% is going to be used for your closing costs to help you. So they actually overfund by $1,995. There is no down payment that's needed. This is an 100% financing. So you're going to get a first loan for this. You're getting a second loan for this. The total funding and financing that is involved is a little bit over this sales price. So they're giving you this $1,995, You see the loan is overfunded. There's what it's, the combination of the first and the second is right there, and then there's the sales price. So they're giving you a little bit extra money to use toward your closing costs, because you will have a lot of closing costs to get into this house. And so this will help you to buy this house with nothing out of your pocket. We'll get into that as the video progresses. So both loans will be under the CalHFA program. This is just a structure of how your loans will be set up under this program for this specific house. And everything that I'm telling you applies only to this house, the numbers especially. So you can't really take these numbers to a different house that has a different list price. We'll have to rerun those numbers, but this is specific for this home. Estimated monthly payment, as I said earlier, the first loan has a principal and interest payment of $19.98. The second loan has 0 payments. Those are deferred payments. You don't have to pay any monthly payments on that second loan. Remember, we said the second loan was $13,965. You don't pay any payments. They're deferred payments, so interest accrues every month. And we'll go into that a little bit later. The taxes are estimated, property taxes, you have to pay those, are at $415.63. Hazard insurance, in case your house burns down or something happens, is $99.75. And you have to have private mortgage insurance, PMI, which is $177.39. PMI is insurance to the lender that protects the lender in the event that you were to default and not pay your mortgage payments. The lender would get paid off by this insurance company who collects these payments from you. So if you add all these figures up, you're at $2,682.64. That would be your monthly payment every single month. This would stay the same. This is fixed. It's a 30-year loan, fully amortized. Okay, it doesn't go up and it doesn't go down. So this is going to be fixed, and we'll go a little bit into that a little bit in more detail. There is no second. Your taxes, this may go up a little bit depending if your property taxes are reassessed by the county assessor's office, but right now it's going to be fixed at about this figure. Now notice that these are estimated numbers because we have no idea what your actual insurance company is going to quote you for your hazard insurance, and we don't know what the final tax figure is going to be when you close your escrow. So, but these are pretty good accurate figures. This is estimated as well because this depends on your credit score, your mid-FICO score, which is your credit score. So we're assuming a 700 FICO in this example to come up with this figure, but this can also change. But this is a pretty good rough idea of what your monthly payments are going to be on this house. So looks pretty good. And remember, I said earlier, you know, you're paying this amount, but if you look at the past slide, I said that you're going to come in out of pocket of $4,420. So how nice is that? You have to come in with $4,400, which somebody from your family can give you, okay? And at the same time, here's what your monthly payment's going to be. That's pretty nice. How many of you are paying close to this in rent? And you can own your own house and have the flexibility and tax benefits of being a homeowner and remove your landlord from dictating how you live your life. Anyway, so a little bit more on private mortgage insurance. It's known as PMI, okay? That's what it stands for, private mortgage insurance. It's required because your financing is 100% of the sales price. The sales price is $399, and we're borrowing $399 to finance this purchase. So the lender is going to require PMI, okay? It ensures the lender should you default on your loan, in case you lose your job for whatever reason and you can't make the mortgage payments, the lender gets paid off. Genworth Mortgage Insurance Company is the company that's going to provide the PMI to the lender, okay? Only that company is acceptable to CalHFA. But once you have over a 20% equity stake in your home, the PMI goes away. So you're going to be making payments every month. But once you show that you can have a 20% equity in the home, these payments eventually will go away. So this is not for the life of the loan. It's only until you can show that there's 20% equity. Okay, so you're using 100%. So you need to accumulate 20%. So over time, this will happen. Prices may go up. Maybe you pay a little bit more on your mortgage. This will climb up. Okay. Also, there's two types of PMI types to choose from that are available to you. This thing called the single premium PMI, you can pay the full amount off at closing. This is a big chunk. If you pay this off, this goes away, the monthly PMI. If you don't pay them off, you're choosing the monthly premium PMI type, which is basically you're making these monthly payments. As I said, you pay the monthly PMI payments with the monthly PMI type. But if you choose the single premium PMI type, you come up with a big chunk of money, right around $7,000 to $8,000 up front when you close your escrow, but then you don't have any monthly payments. This goes away, so that lowers your mortgage payment. Okay. So anyway, the housing payment is affected by the type of PMI type that you choose. But if you want a lower monthly housing payment, you just pay it all up front. As I said, you would get the single premium. Otherwise, include the monthly PMI in your housing payment because you're choosing the monthly PMI type. Okay, and now what are your out-of-pocket expenses? Okay, these are the things that you're going to have to pay up front. We mentioned earlier that you're going to have to come in with about $4,400. This is part of that. You have to pay for the appraisal. That's estimated at $500. And this is an expense you're going to have to pay to the appraiser. The lender orders the appraisal, but you have to pay it. So you have to be prepared to get into your check debit card or a credit card, and you have to dish out this money. Also, you're going to want a home inspection. You got to pay the home inspector probably around $400. You want to make sure that the house is okay, that the electrical, plumbing, all that stuff works. Also, we need to pull your credit report. So the credit reporting agency is going to charge you right around $30 for me to pull a credit report. And this is typically per applicant, so this can go up. And also, you have to take a home counseling class. Cal HAFA requires a home counseling class for first-time home buyers, and I'll go into first-time home buyers in a few minutes. But the class costs about $100, and the class is taken online. You just watch a video, do some reading, and take maybe a quiz or a test, and that's an $100 expense. Okay, so these are things you're going to have to pay once you're in escrow out of your pocket. The total out of pocket is estimated at $1,039. Notice I said estimated, okay, because we don't know what the housing inspection fee. It could be $350, it could be $500, this could be $425. This is $100, so that's fixed. So it's an estimated figure. And all of these are non-refundables. You have to pay these. If you don't close on your deal for whatever reason, you change your mind, you're going to lose this. So be prepared to dish this out. These expenses need to be paid as the transaction moves forward. So I just wanted you to be aware of what these items are. Also, what amount do I need to come in with to close? Remember, well, actually, let me go in here. Your closing costs are estimated at $15,376, and that is a lot of money. Yes, you're thinking, oh my gosh, I don't have that money. How am I going to get this done? Well, remember earlier I said that the lender is going to credit you through their overfunding on that second loan. They're going to give you $1,995 because the combined loan to value was 105%. So, or excuse me, 100.5%. So 0.5% of the overfunding is going to go toward your closing costs. So from these closing costs, you're going to have almost $2,000. So this now drops to $13,000. We're also going to ask the seller to give you a $10,000 credit to pay for your closing costs. I'm going to show you how they're going to do that and why they're going to do that. So this will help. So here's $10,000 of that $15,000. Add another $2,000. There's $12,000. So now you're stuck with $3,000, and you have to come in with a deposit. Okay, you got to come in with about a $1,000 earnest money deposit to show the seller that in good faith that you want to purchase this house. So this is going to be another out-of-pocket expense, okay, in addition to this expense. So now you're at $1,039 plus your deposit. So you're at $2,039, okay? And the total credits to you are just under $13,000. If you take the negative figures here, you add them up, you're at $1,295. $12,995. We said the closing costs were $15,376. So the total additional borrower contribution is $2,381.62, right? That's the difference between this figure and this figure. But we also said you had this $1,000 out of pocket to pay for these items. Okay, these are the non-refundable items. So if you add these two figures together, that's the $4,420 that you need to buy this home. That was on my first slide, if you remember. But again, this can come from a family member. You can talk to a family member and maybe they want to gift you the money. Okay, if they do that, it's zero out of pocket. How wonderful is that? Okay, you can maybe have some sort of arrangement to pay them back that I'm not aware of or the lender's not aware of, but that's something between you guys. No, you know, don't tell the lender. That's going to be an arrangement that you guys will need to make outside of escrow. And all closing costs are broken out at the end of the presentation, so you'll see exactly what these $15,000 are and what they entail, their escrow, title, lender fees, recording fees, notary fees. So there's a lot of different expenses that every escrow will have that you will have to pay, and those will be outlined for you. Okay, now how much money do I need to make to qualify? The maximum debt to income ratio is 45%. Okay, so basically what that means, the lender is saying that they're taking your total debt and they're taking your total monthly gross income and they're dividing the total debt by the total income. And they want to make sure that your total monthly debt does not exceed 45% of your income. Okay, and this total debt includes not only your housing payment, but any other debt that you have. That could include monthly revolving and installment payments. These are going to get pulled from your credit report. So these can include credit card debt, student loans, car payments, etc. Okay, so if you take that housing payment that I talked about earlier, where you're at $2,800 or so, okay, and you have $100 in monthly debt or $200 in monthly debt, these items here are going to represent what you pay in credit cards, student loans, and car payments. Okay, so best way to do this is take that $2,800, add whatever your car payment is, your student loan month, these are your minimum monthly payments now, add those together and then divide by your income, your gross monthly income. So if it's a husband and wife, two borrowers, maybe the husband makes $50,000, the wife makes $40,000, so you're at $90,000 is the minimum income to qualify under this 45% debt ratio. And these are the figures. This is the gross annual income that you have to make to qualify under this 45% debt ratio after you add up all of your revolving and installment debt to your housing payment and then divide that monthly figure by your monthly gross income for all borrowers. So you would have to take, for example, this figure, divide this by 12, that gives you a number, and then take the housing payment, take the monthly payment for all of this, and then divide it, and that tells you what income you have to make. So this is an important slide, it's an important video. You have to kind of see where you're at to determine whether you would qualify under this program. If you don't make these figures, you don't qualify. Now the good news is there's other options that we have, other loans that have higher debt ratios that you can qualify for, but those will require a little bit of a down payment and the interest rate might be slightly higher, but that doesn't mean you can't qualify. That might be offset by the lower interest rate on this program. So this slide is a good slide. It tells you what you need to make. These are the assumptions of the additional debt that you have in addition to the housing debt, and this tells you what you need to come in with. Now let's move forward. First loan information. This will be a Cal half of first conventional mortgage. We mentioned earlier the first loan will be for $387,300. This is a 30-year fixed interest rate, fully amortized loan. It's not an ARM adjustable rate mortgage loan. It's fully amortized. That means every single month you're going to have the same mortgage payment. It will not go up, it will not go down. However, what will change with that mortgage payment is the total amount of interest and principal that will be deducted from that mortgage payment. And then eventually after 30 years, assuming you hold on to the house, hold on to this mortgage, you will paid off this loan. Payments are fixed for 30 years. They'll never go up or down. There is no prepayment penalty. So if you ever sell your house and pay the loan off, you don't have to pay a penalty because you're paying it off before the 30 years. You can refinance this loan whenever you want and pay it off. So that's a nice thing about it. Also, the mortgage rate will be 4.625 or 4 5/8 is the mortgage rate. Now here's the annual percentage rate. That's the total cost of borrowing credit. It's always going to be higher because there's lender's fees that are included here. There's the appraisal. And so I have to disclose by law what the APR is every time I disclose a mortgage rate to you. Okay, and this is as of 7/19. That's July 19th. These rates change daily. This is not a guaranteed rate for you. Okay, this is just an estimate as of that day. But they can go up or down daily. You can't get this rate until your loan is locked, until your rate is locked. Okay, mortgage interest rate is estimated until the loan is locked, and you can lock the loan and the rate after the lender gives you conditional loan approval. So right now we're just talking, but if you were to say to me, hey Andy, I'm interested, let's move forward, first thing I would need to do is get all your documentation. You would take a loan application, I would pull your credit and run the debt ratio and all this stuff and pre-qualify you, and if you're good to go, I would then submit all of that to the lender. The lender's underwriter would receive all that information, and within 2 to 3 business days, they would give you what's known as a conditional loan approval. And what that is basically it's telling you, look, if you meet these conditions, we will fund this loan. And it's only at that point that we can check rates for that day and then lock you. And then whatever rate is as of that date, that is what you will receive. So that's a little information on the first loan. Now here's some information on the second loan. Remember earlier I said that the payments would be deferred. This is a fixed deferred mortgage payment program. It's called the My Home CalHFA program. Okay, the way this works is you never make mortgage payments on this. It has a 2.5% interest only loan. That's pretty low, and interest is added to the principal balance every single year. Okay, so remember, we said the second loan is for $13,965. It's over a 30-year term. It has no prepayment penalty like the first loan. Okay, so every single year, the total interest based on this 2.5% interest loan is $349. So this $349 every year gets added to what you borrowed initially. So loan balance after 1 year this is what you borrowed, right, up here. Then you add this interest at 2.5%. Your new balance that year is this, $14,314.13. It goes up every single year by $349. Okay, and this loan must be paid off. It is not a grant. So if you do get a little bit of money, you may want to pay this off because this kind of continues to go up. So if you were to sell the house or refinance into a new loan, you want to make sure that this gets paid off because this does go up a little bit every year. But you don't make any payments. It's not a monthly expense to you, and it's not used in the debt to income ratio calculation. Lender requirements, okay? We mentioned the debt to income ratio was at 45%. You need to have a minimum credit score of 640. That's your FICO score. You have 3 credit reporting agencies, basically. You have Experian, TransUnion, and Equifax. Each of those will give you a credit score. You'll have 3 scores. The lender will look at your mid-credit score. Okay, and it needs to be 640. If it's not, you don't qualify. Then we'll have to work together to raise your score, which we can do, which we'll go over in a little bit. So you have to be a first-time home buyer. You cannot own a home in the last 3 years. That's very important. Okay, if you owned a home in the last 3 years, you don't qualify. So this is perfect for tenants. If you're a tenant, you've been renting, it's time to buy. Okay, you need to get lender underwriting approval. That's required. We talked a little bit about that, where you have to submit your application, we have to pull your credit, you have to get me documentation, and then the lender's underwriter will look at all of that and give you conditional underwriting approval. Home buyer education is required. Okay, we talked about that a little bit earlier as well. You have to take a class, and then you have to pay that $100, and then you have to get a certificate saying you successfully completed that home buyer education program. Also, this is an income-driven program through CalHFA. So all the borrowers combined, their annual gross income cannot exceed more than $128,700. If you're making more than this between your husband and wife, you don't qualify under this program. And most people, however, the good news is, I would say most tenants are not making this amount of money. So, because if they were, they'd probably be owning a house. So it's a great time for you to buy. And you must live in the home. It has to be your primary residence. You can't buy this as a rental, rent it out, and receive rental income. That won't work. Also, there's no seller leaseback allowed. And what this is say you write an offer to buy this house, the seller accepts it, and you're in escrow, and then the seller says, well, I need 45 days to continue to live in this house after escrow closes, and then I'll move out. No. When escrow closes, you're moving in. You have to be in here within 60 days. So no seller leaseback. And you have to have a home warranty. This lender, CalHFA, requires a home warranty. And the home warranty, basically, what that does is it's an insurance warranty that covers anything that goes wrong after you move in to the home. The lender requires this. So let's say you buy the house, 4 months later there's an electrical problem, or something happened with the toilet and it overflowed. And what you would do is you would call this company and you would tell them, hey, something's wrong with this or the other, and you would have to pay like a $70 fee, and a licensed contractor typically will come out to the house and fix all this for you. Whatever is needed, replace the parts, later, it's all covered. But the premium is about $400 to $500 a year, and we're going to get the seller to pay for this. It's very standard when you're writing offers. It's the seller typically in good faith will pay this for the first year to make sure that you're covered. And the lender, Cal HAFA, does require this. So I'm going to show you when you're ready to write the offer how we're going to get this done. Also, the first loan can't exceed $453,000, which is the conforming loan limit through Fannie Mae. That won't be a problem because we're not buying a house that's greater than $453,000, but that is one of their requirements, so I put that in there. Additional requirements do apply, but these are the main ones. What I invite you to do is below this video, you'll see the full guidelines that are written underneath in the post. So if you want more details, go ahead and look through all that, or even better, call me. I'll tell you what those guidelines are, and let's start talking. Let's start getting you into a home. Now, what to include in the offer when you're ready to buy. So say you get pre-approved, everything's good, and you're ready to move forward. We're going to ask the seller to accept a $399,000 sales price. And we're going to ask the seller to give you $10,000 in closing costs credit. And the reason we asked for the $10,000 because you need this, because you're trying to buy this with minimal out-of-pocket. So if you offer them $399,000, which is the list price, which is what they want, and you're asking for $10,000 as a credit, truly the net offer price to the seller is $10,000 below what they're asking. So really you're offering them $389,000 because they're going to net $10,000 less when escrow closes. And that's a pretty good offer on a $399,000 price. You know, you're basically asking for $10,000 less. If they come back and they don't want to give you this credit, then tell them you'll offer, you know, $409,000 and then ask for the $10,000 credit. It's the same effect to them. It's a full price offer. They should accept it. I've never had a seller decline a credit. They're going to look at the net figure. And plus we have the listing on this house, so we can talk to the seller. They're our client as well. So there's also flexibility when you're the listing agent and you're dealing with the buyer as well. We want to ask for a 45-day escrow period just to prevent issues that may need to be resolved. Typically, it's $30 to $45 when 30 to 45 days when escrow closes, and so this is very standard. We're going to ask the seller that they accept $1,000 as your good faith deposit. I mentioned this earlier. It's $1,000. Maybe they come back and say, "No, I want a $2,000 deposit." You have to be ready to get a counter potentially for some of these items, and then if and when you do, we'll talk with you and we'll discuss on how to deal with that. And then, of course, we're going to ask for a 1-year home warranty premium that we discussed earlier. And then you need these items accepted by the seller for the numbers that are discussed in this video to work. So, and I'm going to show you how to do that when we're ready to write the offer so that we can get you into this home. So it really is a good program. Again, the summary, you can buy this house. This is going over everything I just said. You buy this house for $399,000. The total housing payment, principal, interest, taxes, insurance, and monthly private mortgage insurance is $2,682. Your total out-of-pocket, $4,400. Wow, this is amazing. You can buy this house for $4,400 and your monthly payments are $2,600. How much are you paying in rent? I bet most of you are over $2,000, $22,000, $23,000, maybe $20,000, maybe a little bit. So another couple $100 at most, you're an owner and you're getting equity, you're getting tax breaks, you're removing the landlord from your life, and you're getting, you know, security. So again, this can be gifted, this $4,400 from a family member. So again, stop renting and start owning your home. Move in within 45 days. It really is a beautiful program. I'm the listing broker. My name is Andy Bojarski. That's my picture right there. I own a company called Montage Mortgage. I work as a mortgage broker with a lot of the lenders that are approved through Cal HAFA. This is a great program. This is my contact information. This is my broker license, my NMLS license. I'm fully licensed and insured and all that good stuff. So you're dealing with somebody that's been around for a long time. I've been a broker since 1994. I've closed over right around 600 or so, 650 transactions, over $132 million. I know what I'm doing. You're in good hands. I urge you, I invite you to call me, talk to me, and see how we can get you into this home. And if this home is not for you, we'll get you into another house that has this price range, which will have similar payments for you. So there's no need to be spending your money, giving it to the landlord, not getting a tax benefit on your Schedule A, on your 1040s, okay, and then having the landlord control your life. Maybe they tell you, oh, we're going to raise the rent, or oh, I'm going to sell the house, you know, or maybe they don't fix things when they break, and now you're at the mercy. So, or maybe they tell you, oh, you can't have pets. So many different issues come up that you can remove from your life by just being a homeowner. So I urge you to do this, and call me. Please do call me. Take down my number. Here's my number, 951-440-8214. You can email me, and I will certainly connect with you. We can talk at your home. I'll explain all this to you in great detail, answer all your questions, and then hold your hand if you're a new first-time home buyer, step by step, and then you'll eventually be a homeowner. And you'll be so glad you did it. Truly, this is not a gimmick. This is not something that I'm trying to pull over you. This is a real serious program that Cal Haffa offers. You can research them, check them out, and then let's get you into this house. So anyway, thank you so much for listening to this video. I know it's been a little bit long. I hope you got something from it, and I certainly look forward to talking and meeting all of you in the near future. Thank you so much. Bye-bye.